Okay, great. We're going to get going. Sorry for the delay. We've just had a very high level of people asking to join into the webinar today, which is great. So my name again is Frank Milone, one of the founding partners of FML, and just want to introduce the firm, introduce our co-presenters today, and the partner firm that we were doing this with, Updike Kelly Spelsey, and two of their partners, and we'll get going. So today we're going to talk about the two real topics: the PPP loan, the loan forgiveness application has come out, and we're going to be giving a brief update on that. And Bill Claffey from my firm will be helping with that, along with Jeff Walter from UKS. And then we're going to get into unemployment and return to work issues as the state is opening up and surrounding states are opening up. Employers and employees have a lot of questions as to what it means from both a legal and accounting perspective. So at that point, we will ask our panel members to talk through that issue as well. FML really quickly is a full service accounting firm. We're headquartered in Glastonbury, Connecticut, over 80 people, 13 partners. We have an office based, another office in Enfield, Connecticut, and we have satellite offices throughout the entire state. We also have a COVID task force. Hopefully many of you have been getting our emails and our releases, trying to stay on top of the issue for our clients and our contacts. Feel free to reach out at any point. With us today is Updike Kelly, and one of their partners, Jeff Walter, will introduce himself and also give a brief overview of UKS as well. Jeff?
Okay. Really very similar to FML in the legal space, full service business-oriented law firm. We have offices in Hartford, New Haven, Middletown, and a couple of satellite offices around the state. I think by and large people on this call probably know who we are, and I don't think there's very much more to say other than what I've just said at this point.
Perfect. Thanks, Jeff.
Hey, Frank. This is Chris Brigham, and I apologize. I'm on the call. So I'll just and I apologize to the attendees. I had some technological difficulties, but I'm here. I'm a shareholder with Updike Kelly and Spelsey, chair of our employment practices group, and I will be sort of addressing after the PPP loan forgiveness discussion. I'll talk through some unemployment, return to work issues for employers as we open up the state.
Perfect. Thanks, Chris. Hey, Jeff, we're having a little bit of communication issue on your side. So again, I know some of it is beyond our control. Try to see if you can limit the bandwidth and maybe get closer to the mic. At this point, I'm going to turn it over to Bill, and we'll start the presentation.
Great. Thanks, Frank. For those of you that have attended our webinars in the past, welcome back. For those of you that are new, welcome to our webinars. Really a pleasure here to be doing this with UKS. I think it offers a great perspective that may be a little different from the CPA view of things. Just a quick introduction of myself. I'm a partner at FML. I'm on the tax side. I am an attorney by degree, but I've been with CPA firms since graduating from law school. And I work on the tax side, work a lot with our tax policy and tax procedure type issues. I do a lot of state and local work, and also do a lot of credits and incentives, and have been leading our task force, as Frank mentioned, since mid-March. And just trying to get information out to anyone who really wants it, clients, others that are just poking around, and hopefully you find that informative and helpful. So with that, we're going to start. We're going to go through some updates since our last webinar, really focusing on the PPP application. And I'm going to try and throw it over to the other folks here, Frank, Jeff, and Chris, to give some other perspective, but I'll go through kind of the nuts and bolts of what's there as we know it as of May 21st. So if we go to the second slide, just some general updates. We've got, as many of you may have been, watching this, you've seen that the SBA has created the safe harbor date, which was originally May 7th, and then they pushed it out to May 14th, and then it was pushed out to May 18th. That's in regard to the good faith certification. We're obviously past that date, but for those of you that were following that, you did have that date to give the money back. If you thought that the question 31 and the additional question regarding private companies applied to you. However, in that interim period, we got question 46 in the FAQs, which gave this safe harbor to borrowers that had under a $2 million loan. And what it provides, right? It provides that you're deemed to have met your good faith certification that the loan was necessary, but then it gets into some liquidity discussion. And I'd like to throw that over to either Jeff or to Chris to kind of give your guys' perspective on whether you think that's going to be something that the safe harbor is going to prohibit the SBA from taking a look at that good faith certification because they've deemed it appropriate, or whether you think there might be any wiggle room and maybe just a tougher burden of proof for the SBA to challenge that good faith certification.
This is Jeff Walter. I think the first thing to note is that certification really relates to the initial application for the loan, the PPP loan in the first, and we're getting, beyond that in most instances at this point. I think for the loans under 2 million, that safe harbor will essentially be the prevailing determination. Everyone who received less than 2 million will be deemed to have made receive the loan amount in good faith. Now, fraud is always going to be applicable, and the safe harbor is not going to protect, fraudulent activity. SBA will always have the ability to pursue a fraud claim. In terms of people who receive more than $2 million, there's, if you read through, kind of the additional guidances that have come out, initially it was, we're going to refer you for criminal charges, and now it's kind of come back to, if we determine you did not have the appropriate basis to request the loan, we will first ask you to repay it. And we're really not going to be referring you to other agencies, which means, criminal prosecution. So they've taken, kind of some of the fear out of this, but it will still apply in fraud, and it will still apply in cases where people will go over $2 million in loan amounts really did not have any reasonable basis for requesting the loan.
Great. So yeah, so I mean, you can see, and we're going to get into it with the loan application being published. I think the general sense, right, was that you had the program that came out, and then you had kind of a tightening of the reins coming in through various pieces of SBA guidance. And I think this question 46 at least was the first basis for kind of loosening of that range a little bit, giving borrowers maybe a little bit more certainty in an otherwise uncertain economic environment regarding the loan. And so I think it was really important that came out. But moving on, we've also got a new interim rule, and just for folks that, it's really limited to seasonal and to partnerships, but I know that there are a number of partnerships that were, when they were applying, they were only using employee payroll for their computation of their loan amount. And then the SBA came out, and so they missed the boat kind of on getting general partner compensation included in their application. Well, this interim rule 13 CFR 120 provides you an opportunity to update your loan application without having to go through the loan process again and submit a second loan, which would be inappropriate anyway. Okay, moving on. So we've got the loan application, the loan forgiveness application, which came out. A lot of folks have probably looked at it already. We've broken it down into the three areas, right? You've got some new concepts that are coming in through the application. You've got a clarification of questions that I know I got tired of saying to folks that I was speaking to, we're waiting for guidance, we're waiting for guidance, we're waiting for guidance. And so you've got some clarification on those issues. And then we've identified some other questions that we've been asking ourselves and talking to clients about that I think are still unanswered. And just note that the SBA has promised additional guidance. I haven't seen it as of this morning, but you know, who knows? It could be up later this afternoon. Okay, so let's get into the new concepts. I think the most, you know, potentially critical new concept here would be the introduction of this alternative covered period. And it's important to note that this alternative covered period is only available if you pay payroll on a biweekly or more frequent basis. So if you're a twice a month payroll company and our business, this is not going to apply to you. If you pay payroll on a monthly basis, it's not going to apply to you. If you pay biweekly or weekly or some other more frequent time frame, then you can take advantage of this. And what it's going to do is it's just going to move your covered period up to the first date of your payroll. So, you know, every client's different. I did kind of a little example on an Excel spreadsheet, and in that spreadsheet, if you had a loan disbursement date of if you had a loan disbursement date of the 5th of May, for example, you would get, under the new rules, and we'll get into the cash versus accrual concept, but under the new rules, you could potentially get 67 days of payroll versus the 56. If you elect this alternative covered period basis, you can get 70 days of payroll. So again, if you have the right fact pattern, it's something you probably want to examine and say, hey, does this make sense for us? If you do make that election, that election has to carry forward for all of your payroll calculations and timeframes and calculations regarding FTEs and so forth. Just the last bullet there. If you do make the alternative covered period election, you're going to have to keep track of two different covered periods. You're going to have your standard covered period for your non-payroll costs, and those are going to get tracked from disbursement date to 56 days out. And then you're going to have an alternative period, which is going to be, it's basically going to push your covered period up to the your alternative covered period up to your payroll date, and then go 56 days from there. Other new concepts here. We've got the full-time equivalent simplified method. I know a lot of folks that I've been talking to have really sensed some frustration with having to go through their FTE calculations, especially with respect to their part-time employees. So the alternative simplified method, and there's two things here. One is a clarification, which we'll get to, although I'm going to talk about it right now. They've pushed the FTE definition from 30 hours, which we've probably discussed on prior webinars, and was part of other SBA guidance not related to PPP, and they've pushed that up to a 40-hour concept. However, if you have under this alternative simplified method for part-time employees, any part-time employee, so someone working less than 40 hours a week, you can elect to include them as 0.5 of an FTE. So, we're recommending that folks, as they're going through their analysis, to keep that in mind. It may be to your advantage to treat everybody as 0.5. It may just be an administrative ease of your burden in going through that. If your fact pattern stayed relatively consistent, to treat all your part-timers as 0.5. But there are fact patterns where treating them as 0.5 may hurt you if they're working, let's say, more than 0.5. They're working, 80% of the time in your covered period. You're going to want to keep that FTE count high, because remember, that's your numerator versus your denominator.
Hey, Jeff, have you, this is Frank. Jeff, have you been advising clients to do both calculations at this point to determine what the best answer is?
Yes, we've been telling people, essentially these rules in the abstract are very hard to understand and master. It's easier to kind of learn them by applying them to a specific set of facts. And just given the changes, nothing is certain as earlier, more guidance is forthcoming. Some of the things we're talking about today may be subject to change. And we're telling people to basically game plan, make some assumptions, do more than, do multiple, spreadsheets or calculations, just so you can, make, plan as well. I think the larger issue that what we're really telling clients is, you have to plan to run your business. If your focus is strictly on loan forgiveness, and what happens up, say, through June 30th, that's kind of a magic date, in PPP parlance in many respects. You're probably, doing yourself a disservice. You really need to think about what's going to happen in July and August and September, and whether you're bringing people back just for purposes of forgiveness. Does that make sense for you? So.
Yeah, I mean, Jeff, let's pause a little bit and talk that through a little bit. There's a couple things that I think kind of play into this, and I know we've had a game plan, but leave it to me to divert us into a different side. But a couple things. One is focusing on operating your business. There's been a lot of discussion between, I know, UKS and FML on what we're advising our clients to not do, which is solely focus on maximizing loan forgiveness without anticipating where your business may be in month 3, 4, 5, especially as the economy is maybe going to be slower and ramping back up. The other thing is talking about the fact that the government is currently, anticipating changes, potential changes. And I know we were going to talk about this a little bit too verbally, and extending that 8-week period maybe to 16 weeks or 24 weeks. There's so many variables that people need to start thinking about. Do you guys want to both, Bill, Jeff, do you want to comment on some of that to kind of let the people understand what's coming down and why maximizing forgiveness at this point may not be the best business answer?
Well, everybody is going to be different, and, I've seen calculations for a wide range of business, for profit, not for profit, in a wide range of industries. And I've also seen, preliminary loan forgiveness calculations. If you're somebody who's been lucky enough not to lay anybody off or not reduce wages, that puts you, in an entirely different situation than somebody who has laid people off. And I can tell you that the FTE, the clawbacks and the like that are potentially applicable, reduce your forgiveness by, a very large amount. There's also the circumstance where, your loan amount, the nature of your business may mean that your loan amount, which was calculated on your 2019, wage base, is artificially high. We have a client that is somewhat of a seasonal employer. They use their full amount of 2019 paid wages because they operated for all of 2019, and they hired all of their seasonal employees, and they got a very large loan amount. Well, they are unable to hire any of those employees in 2020, and their loan amount was well in excess of $1 million. The preliminary FTE calculation reduced their forgiveness to $43,000. So my advice is everyone's different, and you need to understand your business, and you need to be game planning throughout this whole process.
Yeah, there's a couple comments that are being made, and I know, Bill, we had this kind of targeted for a couple slides, but Bill, I'll ask you to comment. I mean, a lot of people talking about the 37.5 versus a 40-hour FTE, and a lot of businesses run their business based on a full-time equivalent internally being less than 40 hours. 37.5 is the common number. We debated this, Bill. You want to jump in and kind of answer that verbally, please?
Sure. Yeah. I mean, the way that the application is, updating all of our preconceived notions on full-time employees, right? I think at the current time, I think you're going to have to include if you If your full-time employees work 37.5 hours, that's going to get rounded, and we're going to get into this, but you're going to do that, all of those computations on an employee by employee basis. Those people, technically work under 40 hours. You're going to round them to 0.9. You're going to divide 37.5 by 40. You're going to get to 0.9. Now, if you've always operated that way, or if at a minimum, if you've operated that way from January 1st, right? Because you've got your numerator, which is your FTEs in the covered period, and you got your denominator, which is either of the February 15th to June 30th of 19, or the January 1st to February 29th of 2020, right? If you always kind of treat these employees if these full-time employees always work 37.5 hours, then you're going to be a 0.9 in your numerator, and they're going to be a 0.9 in your denominator. So there shouldn't be a significant impact there. If you had a change, right, where they were working 40 hours through, or being paid, I should use that term, being paid for 40, or being paid for 40 hours between January and February, but are being paid for 37.5 in your covered period, now you've got a little bit of an issue, because you're going to be comparing a 1 to a 0.9, and depending on how many employees we're applying this against, you could have a significant difference in your number. But as it stands, I think you got to apply the mechanics as they're stated in the application. As long as we're going a little bit off script here, you had mentioned, I know that some of the comments coming in, Frank, were related to the new legislation. So the new legislation is the Paycheck Protection Program Flexibility Act. It was introduced in the House, and it seems to have a lot of support. I just want to quickly go through. I looked through it. I've got like 4 or 5 points that I think are relevant here for purposes of PPP. And obviously, this is going to have to be passed by the Senate, signed by the president, et cetera. But the first is to extend the forgiveness beyond the 8-week covered period. Obviously, that's going to change everything that we're going to talk about today. But if that happens, obviously, you're going to have some more flexibility. Eliminating the 25%, 75% threshold. If you've heard our webinars in the past, you know that we've always said, hey, this is the SBA expanding upon the language that's in the CARES Act. That standard doesn't exist in the CARES Act, but yet we're now put under that standard with the SBA guidance, and that came out pretty early. I think that was in either the first or the second interim rule, so this would loosen that. I don't know if it would loosen it all the way or if it would loosen it partially. So that's the second piece. The third thing I saw in that new potential legislation is looking at the loan term and pushing it out more than 2 years. The next factor was, so if you're currently deferring your payroll taxes, and I know a lot of companies are, we got some guidance on that saying, okay, if your loan is forgiven, you can't defer taxes, but you can defer them up to the point of loan forgiveness. So this new legislation is basically, it looks to allow people to defer them for a longer period of time. And then there's an extension of the rehiring deadline. So when we talk about that June 30th rehire deadline, potentially pushing that out. Okay, so let's keep moving on here. And I'm going to push this over to Chris. Let me go through it real quickly. So they also introduced this FTE reduction exceptions. And so I'll go to the last point first. And when you practically apply this standard, if you have somebody who meets any of these checked reasons that we're going to go through, and they're no longer with you, you just count them as if they are, unless they were replaced. But the 4 reasons, right? You've got the good faith written offer, that goes back to some prior guidance. So if you have that situation, that's kind of not counted against your FTE reduction. Any employee who during the covered period, and that's important, during the covered period or the alternative covered period was fired for cause. And Chris, I'm going to bounce it over to you, but let me get through the rest of these. Any employee who during the covered period or alternative period voluntarily resigned, or any employee that voluntarily requested a reduction of hours. And again, from my perspective on the application, I think it's very critical that at least just objectively that at least those last 3 events happened during the covered period. But then we get into what's for cause, what's voluntarily resigned. And Chris, I'm going to throw that over to you to kind of give some input from the employment law concept.
Sure. Thanks, Bill. Yeah, don't have too much to add to that other than, documentation is always important, and now it becomes even increasingly more important in terms of, documenting the basis for the termination. If it's a for cause termination, obviously we want to make sure that's well documented. We want to make sure that if it's an employee subject to an employment contract with a for cause provision, that your explanation for the forgiveness is consistent with the terms of the contract. And same with the voluntary resignation. All of this stuff starts to sort of overlap and be intertwined, because you're now dealing with documenting your forgiveness, documenting your employment termination for purposes of defending perhaps an adverse claim, and then also documenting it for purposes of unemployment, if your intention is to ultimately contest that. So I guess the easy answer is just documentation becomes really critically important for all those reasons.
Hey, Chris, and you may have mentioned this, but question comes in: does poor performance that was previously documented in someone's file, and then they're count as a kind of fired for cause concept? I would think so.
Historically, no, right? I mean, performance terminations are not synonymous with for cause terminations, but for cause is a contractual concept. There's no definition of, there are some definitions, similar definitions under the unemployment regs. When you start talking about termination due to cause attributable to the employer, that's spelled out in the unemployment regulations. But poor performance historically, and I think even now under the loan forgiveness application, is not the same thing as for cause. That's a higher standard.
All right, great, good answer.
Hey, Chris, I had a couple questions come through the last couple of days too, kind of on that whole front. What if you've got someone who just, as the state is starting to open up, and I'm probably going to blend into some of your conversation later, but as the state's starting to open up, if you have an employee that just says, I'm not coming to the office, I don't feel safe. I mean,
right.
is that potentially a for cause basis?
No, I don't think so. I mean, and we're dealing with that all the time now, and the overlap right between the employment world and this PPP forgiveness world is just that. We're trying, a lot of employers now are returning employees back to work either to obtain the forgiveness or B, due to the state guidelines on return to work. And it's the explanations are all over the map in terms of not wanting to come back. But someone who has a generalized fear or anxiety about returning to work due to COVID, it's not an acceptable reason not to return to work. But I can vary that fact pattern really easily to make it a justifiable refusal. If that employee says, I don't want to return to work because my employer's not complying with the CDC guidelines in terms of safe workspace, or they're not complying with Governor Lamont's, return to work guidelines, then that becomes a little bit different situation.
So Chris, from a standpoint of not PPP, but
Yep.
employment-based decision-making, if an employer believes that they have, complied with all of the regulatory requirements internally to make their office compliant, and someone is refusing to work solely out of their own desire not to, in their mind, get exposed, is that something that can that cause a termination of an employment to that individual? Forget about the PPP concepts, but just in general. And is that a supportable reason to be terminated from an employer perspective?
Yeah, I think it is, Frank. I mean, obviously there's so many individualized factors that go into these, and what we're telling clients is, more than ever, look at things on a case-by-case basis. But we sort of left out of the discussion a little bit the whole concept of the possibility of a disability. And the need to accommodate, and we go back to sort of our old tried and true concepts. When someone can't work due to a disability, you still need to go through those ordinary procedures of having a dialogue, interactive process with them, find out why they can't, see if we can accommodate. And if we can't accommodate, then that's different. But essentially, absent a disability, it's if they refuse to work, you can sort of manage that towards termination.
Perfect. Thanks. Let's get back on track. Bill, why don't you take the next slide?
Okay. Okay. So now we're moving into our questions answered, and this was the biggest one, right? Cash versus accrual. The language in the statute, sum of costs paid and incurred. Everybody, I feel like there was a lot of different opinions on that. Is it both? Do both events have to occur? Does either event have to occur? The instructions clearly are now allowing both events to incur. So you're looking at payroll costs and non-payroll costs. You're looking at all your payment dates, right? So if you incurred them previously, but you pay them in the covered period or the alternative covered period, you're going to include all those costs, and then you're going to get to the end of your covered period, and you're going to have a payment that's after that period. You're allowed to now include the payroll that was earned in the covered period but paid after the covered period, as long as it's in the next payroll cycle. And the same same applies for your non-payroll costs, right? So you've got rent kind of going through you've got your rent payment that comes up in the beginning of your covered period, and you're gonna have a rent payment that comes in after. That payment that comes in after your covered period, again, you're just gonna look at, well, how much of that rent was incurred during my covered period, and you're gonna be able to include that cost. So again, you kind of have this, like, you have a mismatch of like dates of when people were being, when their loan was being dispersed by the bank, and you could have different facts for different clients. But it certainly is, again, this is kind of the loosening of the reins. I think the feedback coming in, certainly the feedback coming into our firm was, great, you gave me a loan on 2.5 months of my payroll. I can't spend this. I can't spend it in 8 weeks. And this, I think this was probably the SBA's answer to allowing that, looking at the CARES Act language and saying, okay, we're going to open up the window, but stay within the statute. Now, if the Paycheck Protection Flexibility Act passes, you're going to have even a wider variance, but that's not passed into law yet. Questions clarified. Okay, so now we're moving on to the full-time equivalent employee. Again, we're doing that, and we talked about this earlier, so I think we're good there. The 40 hours a week, you're going to round everything to the nearest 10th, and it's on an employee by employee basis. If you had tuned into any of our prior webinars and using prior SBA guidance, there seemed to be this aggregation concept, right? People that worked, at that point it was the 30 hours, were a full-time employee, then you took all of your non-full-time employees and you aggregated them to get to a number. That's not what they're doing in this application. You are looking at every single person individually, and at the end of the period, they're going to count as either a 1, they're going to count as a 0.9, a 0.2, whatever it might be, or if they're under a 1, you can use the simplified method and count them as 0.5. Okay, next, another significant issue. Certainly one that I batted around in my head for the last 6 weeks. This whole 75% payroll requirement. Was it an all or nothing? A lot of folks had been writing articles saying that, hey, if you haven't met the 75% threshold, then you potentially have misused the funds and potentially no forgiveness. You would get none of the loan forgiven. The new test is really just looking at it's looking at how much did you spend, and then the way mechanically they're getting into it is they're dividing your payroll cost by 75%, and that becomes the forgivable amount. And so I just gave a really simple example here, right? You got the $100,000 loan, assume no reductions, 70K spent on payroll, 30K spent on non-payroll. Your loan forgiveness is going to be $93,333. I put in the not 95K because that's the way I thought it was going to roll out, right? You spent 30%, so you kind of take the delta on that. But under this new calculation, you just divide the 70 grand by 75%, and that gets you to your number. Okay, questions answered. Okay, now moving on to the general partners. This was also, again, was a little bit of uncertainty in all of your FTE calculations. General partners are not included in that. So you can pay them with your PPP funds, but they will not be considered FTEs for purposes of your calculation. And then with regard to the FTE reduction exception, again, another question that we kind of went back and forth on. It's an all or nothing test. You have to look at your payroll on February 15th, kind of put a stake in the ground on that date, and then look at whether you had reductions between February 15th and the 26th. If you did have a reduction, then you have to fast forward to June 30th, and you have to get back to your February 15th number. If you don't get back to that number, then whatever your FTE reduction calculation is applies. There's no kind of partial reduction in that instance. Same goes for the salary reduction. You have until 6:30 to get the salary levels up. You're going to be looking at all those various periods we just discussed. Important point for both of these. Whether it's the FTE reduction or the salary reduction, the FTE reduction is going to kind of be on an aggregate basis. But if you don't have FTE reduction, then the way that this thing is set up, you do not get the benefit of that, right? So if you had 10 employees on February 15th, and then you had 10 employees between February 15th and April 26th, and then you had 8 employees in your covered period, your calculation is going to be the 8 over the 10, depending on which denominator you use. Whereas you had 10 employees, then you lost one, right? Went down to 9, and then you lost another one, went down to 8, but then you brought them back by June 30th. Now you're eligible for this exception because you did have a reduction. Same goes for the salary reductions. You're just doing it on an employee by employee basis. Okay, unanswered questions. A lot of questions on the transportation costs. I didn't see anything in any of the new guidance or in the application. The only thing that I've seen are gas costs, and that kind of came in through the sole proprietor interim rule. Jeff, I'll throw this over to you. I don't know if you have an answer, but do you have any other different thought on that, or have you gotten questions from your clients on freight and mileage and car payment? We're getting a lot of those kind of questions, and I don't have a definitive answer. I don't know that I have a better answer after the application.
I would say that I don't really have anything more to add there. We've been getting the same questions. We've been hoping that the promised additional guidance may provide some additional insight into some of these items that are in the utility category that are not intuitively utilities. But we have not seen that yet. We've had some clients that have. We have a private school, by way of example, who said, "Hey, I'm going to use my payments I have to make under my school bus contract," and we think that's a little. So we've been very conservative on this, just given that some of these costs around the edges just aren't that large. I mean, it may be in a particular client's case, but when you really get into it, without the guidance, we're telling people to be very conservative. Because you may pick up $3,000 in an 8-week period on something, and it's just not worth the risk of the penalties if your loan forgiveness was that was not supposed to be in your loan forgiveness application.
Hey Jeff, we've had a couple questions come in, and it's the last bullet on this slide regarding bonuses, kind of maxing out people during the period. You have any thoughts on this? I know we talked about it offline. I think your thoughts here would be helpful to the group.
We have been very, very conservative in telling people to be very careful in terms of making bonus payments, or more particularly in creating bonus payments during the covered period. What we've had clients that have said, "Look, I want to reward the people who stuck with me and came into work." And this goes back. Some of this goes back to the incurred during the period. Well, if you're, if you didn't get your PPP loan until May 1st, and you want to reward people for their work February, March, and in April, that it wasn't incurred during the covered period. So there's a lot of ways of looking at and challenging bonus payments. It gets into the fraud issue. When you're sitting there and saying, hey, my forgiveness is low, I'm going to create a bonus program, we're somewhat uncomfortable with that. By the same token, if you have in place long-standing bonus policies and they get paid around this particular point in time, we think that may well be fine, because you're going to be able to demonstrate, look, my bonuses were included in my 2019 wage base, that was included in my loan amount. It's appropriate for me to get it, in this 8-week period. But you also have that whole, proration issue. I mean, to pay an entire bonus and try to say it's all due during that 8-week period, may be a problem. And I can probably go on and on and on, because I've heard
I appreciate it, Jeff. I think what you've been able to represent it is specific to client need, client documentation, and if it's a long-standing concept that you're just paying out normally, you have a little bit more. Hey guys, I'm gonna call a time check here. We're running a little bit late. I don't think this slide needs to be really talked through too much, so I'm gonna ask Bill if I can just kind of let people see it and then move on here.
Yeah, that's not that. I know. I apologize for that, Frank. Yeah, let's move forward.
Okay, great. I think I'm going to pull it over to Chris now. We'll get into the employment issues and we'll continue going. Thanks.
Okay. Thanks, Frank. As we talked quickly earlier, the intersect now between our two worlds is really coming back down when we're talking about returning to work and all the questions that are coming in about how we do that. We talked a little bit about, can someone refuse to return to work if they have a general anxiety about the workplace? The other big return to work issue that we're seeing is a lot of employees out there saying, no, I actually prefer to stay out on unemployment. And I think that's really as a result of the very generous federal supplemental program that's in place. On the slide, there are a whole bunch of acronyms, but they're basically 3 different types of federal benefits. And the one that seems to be getting the most attention is the FPUC. That's that $600 extra a week. And interestingly, that is available to any employee in the state of Connecticut that's receiving sort of $1 of state unemployment. So someone can be partially unemployed, someone can be on a shared work program, someone can be temporarily unemployed, permanently unemployed. And for the time being, they're going to get that $600 a week benefit on top of their state unemployment. So we do have some clients that are calling saying, look, I gave my employees a return to work date. I got to get them back so I can take advantage of my PPP forgiveness. And I've got, employees out there saying they don't want to come back. And what we've been advising simply is, like I said earlier, to communicate with them, try to have a dialogue with them, explain to them that, look, we're open. We need you to come back. If you choose not to come back, we're gonna notify the Department of Labor that we've provided you with a definite return to work date, and they can then sort of work it out. There may be some explanations that entitle them to stay on unemployment, but generally speaking, this idea that I'm enjoying my federal unemployment benefits is not going to go very far. The other issue, Frank, and everyone on the line that's coming up a lot is well, we're now returning to work, but we're a different place than we were 8 weeks ago. We're leaner and meaner, and I don't have, take the restaurant industry for example. We don't have the hours that we had previously. So what's happening there is employers, are bringing people back part-time as opposed to full-time. And just a reminder that if you do bring someone back part-time as opposed to full-time, they may still be eligible to obtain partial unemployment, and/or you're still eligible to do the shared work program, which would allow them for some, partial unemployment benefits as well. I think that covers that slide, Frank. Just a quick word on Family First. It seems like a long time since we've spoken about this. This was the big news in April, and April is now a long time ago. But that was really the first federal legislation that came out allowing for 80 hours of paid sick leave if you have a coronavirus related reason, and then also 12 weeks of extended family medical leave to take care of a son or daughter whose school is closed. Where we're seeing that come back into play now is, again, on the return to work side of things. When we're asking our employees to come back, many of them are in a situation where they can't come back to work because their son or daughter is now, as we know, the schools are closed through the end of June, and they're the sole care provider for that son or daughter. So what we're advising, and I think what the Department of Labor is certainly looking at is if you're in that situation, you still need to return them to work. We had a situation very recently where an employee could not come back to work due to the taking care of a son or daughter whose school closed. And basically what's required is to get them off unemployment, because I don't think it's no longer should they be eligible for unemployment because there is a job available to them, but now they would be entitled to sort of parlay that unemployment into leave, either under the paid sick leave and or the extended family medical leave. They're, just in terms of the substantiation of those two, very, very minimal. If someone needs to go out on paid sick leave, basically all they got to do is put in writing that they have coronavirus, they're home with someone with coronavirus, or they have the symptoms and they're treating, and they're pretty much eligible for that 80 hours. And the same with the extended family medical leave. They need to provide you with the name of the school and make a certification that they're the only one that can take care of that son or daughter. And essentially, you're required to provide it. The 80 hours of sick leave is both of them are paid at 2/3 the regular rate of pay. And as Bill probably can attest, I don't know exactly how the tax credit works, but there's a payroll tax credit on the back end for both of those paid benefits for the employer. I guess we can move to the next slide, Frank. So just some back to, again, sort of cycling back to some return to work issues that we're seeing quite a bit of. Historically, under the ADA, there were tight restrictions on medical inquiries and medical exams, questioning your employees about their health condition or their medical condition. The EEOC has loosened those restrictions during the COVID-19 crisis, so it is permissible to administer a COVID-19 test if they're available for your employees, as long as you do it sort of across the board and consistently. You can make it mandatory. The employers that I know of that are doing it are making it voluntary, and they're getting about 100% compliance. You do need to be flexible in terms of accommodating any disabilities or any prior medical condition that might make it unsafe for that person to be tested for any reason. But essentially, what's sort of ruling the day here is the employer's responsibility to create a safe work environment for all of your employees. So keeping someone out of the workspace that has COVID and that could be a direct threat to themselves or to others is sort of the guiding force.
Hey, Chris, quick question. The
Yep.
FMLA concepts that we were talking about, just want to reiterate this because I think a question came in. They do apply to small businesses at this point. There's an ability to try to opt out, but there's a process there, correct?
That's right. I mean, the exemption only applies to employers with 50 or fewer employees, and it's pretty onerous. You basically have to show that to some extent or another that you're not going to be able to continue in business by providing this benefit. So 12 weeks of paid leave at 2/3 that individual's rate of pay with a tax credit on the back end. You can see that it's pretty hard to support on an economic basis. But for really small employers, who have 5, 6, 10, 15 employees, and you really you can't get by without that particular individual, there'd be a more compelling argument for it.
Perfect, thanks.
Just looking at some of these questions on the slide, another one that's fairly controversial and is being asked frequently is just how to handle PTO as we return the workforce. I mean, we're returning our workforce to work in the middle of the summer months, which is a high vacation utilization time. And the most employers, unless you have a policy to pay accrued and unused vacation upon termination, PTO is a benefit. There's no statutory or legal requirement to provide it. And what we're advising employers is simply to, when I have a small dental practice that is, for instance, had their employees agree to a blackout period, or you can have them buy out some PTO or have them delay PTO. But again, as we've talked about throughout the presentation, it's really a case-by-case basis. I mean, you can easily think of a scenario where someone, has scheduled in August, they're a family wedding. You're going to want to work around that with them, whether it's providing some unpaid leave or some other accommodation.
Hey, Chris, question. Yeah. I found it to be a good one. Can employees push an employer to implement some sort of testing for COVID? And if the employer doesn't agree, is there a claim there that the employee can then make at that point?
That's a really good question, Frank. Not one that I've been asked, and that's why I love these things, because there's always, a new angle to look at. I don't think so. I don't think that there's no mandate, obviously, that testing be conducted. Certainly, it's complicated by cost. It's complicated by availability of the testing. I think there are ways to work around that. If someone only feels safe if everybody in the workplace is tested, I think the employer can rely on the guidance that's been provided and stick to that.
Perfect, thanks.
Okay. So I think I covered some of these other questions. Refusing to submit to a mandatory test, again, I'm sort of counseling against, the gut reaction to move towards an adverse employment action. Most of these situations, I think you can dialogue with your employee and figure out. But ultimately, if you've got a mandatory testing program and someone refuses, and they don't have a medical reason for that, I think it's now going to be a question of whether that employee causes a direct threat to the rest of your workforce.
So really quickly, we're at noon, but we're going to continue to go. I made a published announcement. If I'm hoping that Chris, you and Jeff can stay on the line for a little bit. We'll keep going. If you can't stay on, we understand. We'll have a recording and the slides will be sent out so you can access the recording and the slides later on. Thanks.
Yeah. And just to say quickly, Frank, I can run through these. There's so much written guidance on what I'm about to cover. We have a lot of information on our website. Clearly, the executive orders are all available online, as well as all the the essential and non-essential return to work guidance. But we're into the day 3 or day 2 here of the non-essential businesses returning to work. So we are getting some questions. Probably, as you can see from the slide, we've sort of outlined Lamont's guidance on this, and most offices are maintaining their remote workforce to the extent that they can. But clearly, if offices need to get back to the physical office space, that is now allowed, assuming you follow the non-essential business guidelines. And I think I've mentioned most of them there. The 50% capacity, and the masks, and the spacing and the social distancing in the workplace. I think, one of the sort of the questions that's coming up a lot for us is the over 65 at-risk employees and what to do about them, because it does, the guidance is a little bit contradictory. You've got Lamont's guidance saying that they should stay home, but you can't necessarily, under the age discrimination and employment laws, tell someone you stay home, you have to stay home because you're over 65. So you need to really sort of manage those situations carefully. And again, on a case-by-case basis, I don't think it's appropriate to tell an age-protected employee you can't come into the workspace, but where it is, where you do have a little bit more ability to do that would be if they do have, some of these, if they're in a high-risk category. And at least there's some covered now under the non-essential workplace guidance to, if you're going to be at 50% capacity, it may make sense, that in terms of the 50% you bring back, the population of employees that are going to be most safe.
Hey, Chris, really quickly,
Yep.
Is the 50% business must limit capacity to 50%? Is that based on the number of employees you have or the office space capacity? So if your office can hold 100, for example.
Yeah, that's based on the number of employees, I believe.
Okay, great, thanks.
Yep. We're also just, this is the time, as always, I'm sure you all hear from your employment lawyers, document, document, document. That's our steady mantra, and that's another reason why we talk about implementing policies and procedures. It's best to have a written return to work policy, so that you have a go-to document that when people have questions, you can say this is our policy, albeit temporary. This is our policy. It's on our website. We've circulated it. So we're helping some clients, draft some return to work guidelines. But it's best to appoint someone at the office to marshal that effort, and then to work with your counsel and accountants to get all this in place. And the rest, Frank, I think the developing the cleaning checklists and whatnot, is straight off of Lamont's guidance.
Hey, Chris, really
Yep.
quickly, and this kind of goes back to some of Bill's points too. And if you have a restaurant, they're limited to half the seating by the governor, and that impact on the FTEs, right? From a standpoint of a restaurant's not going to be able to bring their FTEs back to full if they've only got to manage half the staff, right? Half the base of the, is that going to be, and they have the ability to bring their staff back because they have a PPP loan and now they can't pay them. The question was, hey, I can't use all of the PPP loan now because I can't bring all of my staff back in the interrelationship. Bill, I guess the point there being, that's an unfortunate consequence of what we're dealing with, and one of the reasons why I believe the government is considering extending that period, correct?
Yeah, I think that's part of the consideration. I guess my question, and I see it on the chat line here, is that, what do they mean by bringing back the employees? Are they bringing them back as, employees that are working actual hours at their job? Are they still paying them? I believe that if they're still paying them as employees, right, they're still going to be included as FTEs, even if they're not, going to the restaurant and doing their job at the restaurant.
Yeah,
they're still being paid. Yeah. So
yeah, let's not go too deep into it. I thought it related a little bit to what Chris was talking through, but yeah, let's keep going with Chris on the next slide. Thanks, Bill.
Yeah, and just on the flip side of that, Frank, I mean, I think if they bring them back and they get that partial unemployment option too, but I don't think that would be included, obviously, in the PPP. Yeah. The next slide just is, talks about some of the practical guidance that we've seen, and clearly, the masks in the workplace are going to be a thing that's going to be around for a while. It initially came out that you had to wear masks at all times, and then the supplementary guidance came out and said, masks in common places in the hallways in the building, but if you're in your private office or cubicle, you can drop that down to your neck, which is a big relief, I'm sure, for everybody. And then just reconfiguring the office space. I don't know, our our group conferences dead to the world for forever? You know, maybe, but I don't see any of us going back and having, you know, the conferences that we used to have. But if we do, you know, we're supposed to keep them down to a maximum of 5 people, create the social distancing, and quite frankly, to avoid it, if at all possible, you know, if you can do a Zoom conference as easily, then you should. I think we can go to the next. Yeah, that was that's a quick overview, but happy to answer any questions and appreciate the opportunity.
Yeah, great. So I think at this point, you know, if we want to scroll through some of the questions, still have about 50 people in the presentation. And, you know, Bill, I don't know if you see any that you want to address verbally to the group. I think we've addressed a couple of these. So can PPP be used to pay out unused PTO time? That's an interesting question, Bill. So I assume that means the employee is not taking the PTO, but the employer wants to pay out any unused PTO. I'm not sure that, I think that's a gray area. You agree with that, Bill? Jeff?
Yeah, I agree. It's somewhat of a gray area. I think it's permissible to pay it, but to pay it in a lump sum and deem it all to be incurred during the covered period is not going to be appropriate. You're going to need to prorate it in some fashion. I think if the employee does take it, you know, and they're being paid because they're, you know, out on PTO during the 8-week period, yeah, I think that's okay. But you know, to just try to pay it out in addition to, you know, wages that are otherwise being paid for the same period, you know, that PTO is earned, you know, on a full year basis and not just during the 8-week covered period.
Yeah. Hey, Jeff, go ahead, Bill.
Yeah, and I have the, you know, very similar take. And I had a really good call with a client yesterday it kind of fit right into the fact pattern that Jeff had mentioned earlier. I mean, they pay their bonuses in May, and that's their standard operating procedure. They've done it for, you know, for many years. And now if they include that in the PPP, like every single person on their payroll, whether they made $100,000 or less, is going to get capped out I don't know that that's specifically prohibited under the application instructions. I think it probably goes against the intent of the certification of the funds are necessary to maintain ongoing operations and retain employees. But it's an interesting take. That's why I threw out the prorating concept on the slide. I mean, maybe that's kind of your, you know, maybe that's the way you kind of you allow that cost to come in, but then you take it on a reasonable basis. So yeah, I would imagine the SBA is going to have to issue some guidance on that. Unfortunately, we don't have an absolute answer.
Yeah, there's another question here I'd want to turn to, because I know that UKS has a number of schools that they deal with. If our teachers are contracted August through June, but their pay is stretched out through August, can we pay early to meet the 75 to 100%? And I assume that means the payroll number.
We actually had this, Chris and I had a call, you know, precisely on this issue earlier this week. You know, it's a 10-month contract, all, you know, and there's something in the, I don't know if it's in the forgiveness application or something talks about, you know, when pay is earned. Okay, so the pay has clearly been earned, you know, during 10 months. Okay, it just is being paid over 12 months. And you run into a couple of issues there. You know, one that Bill mentioned earlier is, are you getting somebody over the $100,000, you know, 15,385 cap because you're accelerating that payment. And where we came out on it, at least in this fact pattern, was, you know, the proration example, to sit back and look at it and take those 2 months and apply 8 weeks of those 2 months, within the covered period, we thought somebody would be fine. I don't think we would have maybe had the same answer before the application came out with the clarification of when pay is earned. I think that statement helps us get to that point a little easier. And we'll see if there's additional guidance that, confirms or, turns, it means we have to reassess that.
Yep. So the next question I'll throw out there is, and I'm not sure any of us are nonprofit experts, but who's considered a general partner in a nonprofit is the question. Anyone have the ability to kind of give a run at that one?
I do a lot of nonprofit work, and I'm involved in a variety of pretty hands-on situations right now. I don't think anyone is a general partner. I mean, and part of this is just the way the nomenclature and the defined terms and the like work through the PPP program. You have to remember that not-for-profits, the PPP program was a replacement or an alternative to unemployment insurance, unemployment that they tried to do through the SBA 7A loan program. Nonprofits were historically not eligible, so in the PPP legislation they made them eligible, and there's otherwise existing SBA rules, statutes that didn't get changed or updated for quote nonprofit borrowers. I don't know the exact context and what this question is being asked for, but I know in terms of the loan application process where they, certain certifications, they just weren't eligible, and those applications went through and were accepted. And, I'm happy, to talk more, specifically if someone wants to call me or email me, but.
Yeah, that's great. I mean, I have, we have your contact. We have your contact information up there.
The real issue is, the entire SBA statute just has provisions in it that never contemplated there was going to be a nonprofit borrower.
Yep. Hey, so question came in, Bill, saying that we kind of ran through the 75% on the payroll piece somewhat quickly, and Nicole has asked that we can kind of just run through that one more time. So I think that was the question as to you have to spend, you can only get 75% of your, up to 75% of forgiveness, right, relating to payroll, Bill?
So, yeah, so the concept, right, the concept that was introduced is 75, 25%. There was a number of uncertainties with it. Are you measuring against the full loan? Are you measuring against the amount spent? Because most companies at the time were thinking, I can't even spend all this money. And so there was a lot of uncertainty. If I don't spend 75%, is $0 of my loan be forgiven because I've misused the funds, right? And so the application clarifies all that. And the mechanically how it does it is you're going to go through all of your costs, you're paid and incurred, and you're going to come up with your number. Ultimately, when you get to the application, you're going to look at the amount that you spent on payroll, and you're going to divide that number by 75%, and that's going to be your cap on forgiveness. Now, you may have reductions because of FTE reductions or salary reductions that take you below that cap, but that's going to be your cap. So in that, like that very simplified, I know it's a really simplified example, but in that very simplified example, you have a loan of 100 grand, you spend 70 grand on payroll. They're only going to forgive because you're going to take that 70 grand that you spent on payroll, divide it by 75%, and you come up with 93,333. So of your $100,000 loan, that's what will be forgiven. And then you'll have to pay back the balance won't be forgiven, and you'll have to pay back that balance.
Yeah, I think, Bill, with all due respect, I got a little turned around on this on our pre-call. I think the math is I think the way they've outlined it is more complex than it needed to be. But I think I would basically encourage Nicole to reach out to one of us if she has any further questions. You know, I'm going to, I don't know, there's another question, you know, if you guys, Chris or Jeff, if you want to take, if an employee has been out on unemployment due to no childcare, but she is being asked to come back to work with her refusal, how should the employer proceed? It's a very specific question, may not be able to get answered with limited facts, but Chris, you want to jump on that?
Yeah, I'd be happy to. I mean, I'm going to assume that the no childcare is COVID related, but that's really not an eligibility factor for unemployment. That's more. I mean, you could probably challenge that in the first place, but I think that falls into the scenario that if the employer is ready to return folks to work and someone can't return to work because they have childcare duties related to a school closure, and I think you bring them off of unemployment and you may have an obligation to, you know, put them out on that extended family medical leave. And I think you can capture, you know, retroactively all the time, you know, that you've allowed them to be out for that reason.
Perfect. All right. Well, I think this has been great. I just want to kind of wrap it up. Chris and Jeff, thank you so much to both of you and for UKS to allowing you guys to jump in and add so much amount of value into a discussion that I think is going to be front and center for a lot of our clients, your clients, and others out there. Hey, Bill, once again, thanks for being so up to speed on everything that's going on here. And I would strongly encourage everyone to reach out to any of us if they have any further questions, and please don't forget to check our websites out frequently. We both have COVID-19 resource pages that we're updating constantly, and we will definitely send out the webinar, the link to the slides. We'll also send out the link to the actual webinar, so in case you missed anything and you want to go back to the Q&A and the discussions, we'll do that. So at this point, I'm going to sign off and say everyone have a great afternoon. Stay safe and talk to you soon.